on after this. What's going on?
Okay. It's Christmas time and busy and I have kids. So what's going on is I'm living life. I'm living life, my friend. How are you doing?
It,
What's going on
it
with you?
is it is Christmas. It is busy. I'm going out Christmas shopping after this because I have to
Nice.
finish that.
Nice,
It is
less than a
busy.
week, but that's okay.
It's just the wife. It's just Anya. It's like
No comment.
it's oh my god. You're my last podcast of 2025. That's
Well,
it.
thank you.
You're the last
That's a
one.
privilege. There we go.
It
Congrats.
is.
How many did you get recorded?
God, I think we did 31.
Wow, good for you, man.
Yeah.
That's fantastic.
I think. I have to double check. I don't know. We've done a few. Uh Renewals. Talking about all things renewals. Because
Renewals.
this is like every speculator about real estate prices has always said that 25 back into 25 into 26 and 27, Canada has like 60% of its mortgages for renewal in this window. And it is your interest rates from 1.5, 2%, all getting renewed at whatever the interest rates are today, which right now it's looking like four-ish.
Yeah, and they recently went up a little bit a few weeks ago. So you're going to be in that like four and a quarter most likely right now. And if you are going to add any debt into that, maybe a little higher. So
Right.
it's definitely a big swing from where they would be prior to the renewal. Right.
How are you seeing the renewals this year coming into 2026? What are your thoughts going into this year?
Um, like you said, I mean, there's a record amount really of mortgages up for renewal this in 2025 and 2026 even more. And so I think the big thing is people are going to be, it may be weighing on them, right? That they're going from these low interest rates to higher interest rates and having to accommodate that larger mortgage payment possibly on top of, I mean, let's face it, the cost of living has gone up drastically and wages haven't really followed suit. So a lot of people have also added debt into their life. So now they're trying to manage that debt. And now on top of that, there could be a renewal coming up that's going to increase their mortgage payment.
That's the stressor, right? Because the idea behind the theory of the market's going to cool or prices will come down is you're going to get people who have to renew because people typically live by check to check every 2 weeks. If you make, let's say, $100,000 a year, it doesn't matter if you make $100,000 a year or $50,000 a year or $75,000 a year. Habitually, the most common element for people's spending habits is if I make $100,000 a year gross, that means I make, let's say 6 grand a month, two biweekly checks of $3,000 for even numbers. Whatever that 6 grand a month is, I'm going to fit into mortgage, car payments, car loans, um, but some clothes shopping. You know what I mean? Like you're gonna
Everything,
live
yeah.
that. Yeah, you're gonna live that amount, and especially in the last few years where you probably weren't thinking about this on the horizon for your renewal, you probably maybe took out a bit of debt. Maybe you bought some cool toys. Maybe you went on too many vacation. Maybe you went out a little bit too much. Whatever it is. Also, Christmas presents. People are going usually big this
Yeah.
time of year, spending a lot of money. So the idea is you're gonna get people up for the renewal. They're gonna get a significant jump in the monthly mortgage payment, and that's going to put pressure on them to do something about their house. Because if you own a house since 2025 and your renewal's up for this year, you have a shit ton of equity. Like
Yeah.
you made a lot of money on paper. Um, so that might mean I get out while I'm ahead. That might mean I have to get out now because I can't take on this anymore. So the idea is we're going to get some inventory back this year. So you're probably already talking to people about Q1 renewals. How are things looking for those people for your clients?
So, yeah, the big thing that I'm telling every client, if you have a renewal coming up, first things first, let's say we haven't talked about what debt has come on the table, is you're going from your interest rate very possibly level. And if that's the case, um, having the ability to shop around and make sure that you are getting the best rate on the market so that transition is as comfortable as it can be is really important because what we're seeing a lot of banks do, and this has been a tale as old as time, is when your renewal is coming up, they're going to say, "Hey, Jason, we know that your renewal is coming up. Here are some options. Do you want another 5 year, a 3 year, a 2 year? Just check the box, send it back, and you'll be done. Super easy." The thing is that when you start looking at some of those numbers, we're seeing them range by a whole percent. Some are in the high fours, and we're seeing some that are in the high threes. Some that are really good, and some that are absolutely horrible. Um, and so making sure one, someone is taking a look at that from an unbiased opinion, saying, um, this renewal, there is a 0.5% or 0.75% higher than what you can access on the market right now. Or we've had people come in that had a really, really active rate. And I was like, oh, like that's a great rate. Take it. You're not going to find a better one on the market. So making sure if that renewal is coming up, a quick phone call, quick email to a mortgage broker could really, one, help give you confidence that you are either getting the best rate in the market or you are overpaying, and the convenience of just checking that box could cost you thousands of dollars, if not tens of thousands, depending on the rate. So that's the number one thing that I think people need to realize is that you don't just have to take the option that they're giving you. It may be very easy. It could just be an email or a piece of mail that they mailed you, and you just have to click a box or check a box and it's done. But to have a quick conversation could save you thousands of dollars. And that's the first thing I would caution people to do that have a renewal coming up. And even all our clients, we check what the renewal is at, what they're offering, and making sure that that's competitive to the market.
Right.
um Part two to that is how are you doing? How is your situation? Do you have kids? Do you have debt built up? Do you have renos that need to happen on the property? Is your health okay? How's life? Has things come up that have forced you to take on debt personally that has built up, and you are now just on a treadmill trying to just keep up with those payments? If so, as you mentioned, a lot of people that purchased a home 5 years ago have a tremendous amount of equity in their property. Equity meaning, cash that you don't really have access to. Unless you
Right.
have a renewal coming up, all of a sudden you get access to that money, right? So, and you can take that money, pay off your high interest debt, and work that into a low interest debt. And so, we did a little experiment a couple weeks ago where we reached out to 10 people, and asked if we knew what their effective interest rate was between all of their debt. So, like car, credit cards, lines of credit, mortgage. If you took it all together, what's the interest rate for all of those things? Not one person actually had somewhat of an idea, and was pretty close, but no one else did. And that's obviously not surprising. Who wants to think
Right.
about that and organize that and try and figure it out? You just want to stop thinking about it because it's causing stress, it's causing depression, and it's putting you in a bad mood. And so why think about it? But in reality, what we try and ask those the reason we ask those questions is we can say, oh, we can take your effective interest rate from 13% between all your debt to 4.
4.
And we can increase, we're working with some right now, we're increasing their cash flow by $750 a month. And
Right.
that's a huge amount, right? And so that's the part two is, and you can consider it a two-part system here if you have a renewal coming up. One is the non-biased opinion, make sure you're getting competitive rates on the market. And secondly, do you have any debt that's built up that is causing you stress um and really making you just spin your wheels on a treadmill trying to pay it off? And why not work that into your mortgage with the equity that you gained, and be able to increase your quality of life and get rid of that stress and live a life that is more fulfilling.
little bit less stress just by
Yeah, a
taking
little
off
less
all this
stress.
debt and putting it into the mortgage payment, right? Because you know. Um, how are you? I mean, when it comes to renewals, you touched a bit there. Is never take the first option. We had this come up earlier last year. I was at a dinner. You remember this? I was at a dinner and
Yes.
someone had just renewed, and the banks were offering 4.5, somewhere in there, and they
Yep.
renewed at 6.5.
Yep.
And we
Isn't that
and
crazy?
all because they received something in the mail or an email, and when they bought, maybe they just thought, well, that's pretty close to what I had when I bought or whatever the heck I did, and they just signed up for this rate. I remember we did the math on that. It was like 25,000 in additional interest payments or something. It was something
Yeah.
crazy for the 5-year
I
term of that mortgage.
I forgot about that situation, and as soon as you started going down that road, I remembered it. And I remembered we calculated the cost to break it, and it was just too much. Like, the interest rate was so high, and it was such a new mortgage that they put on place. The breakage cost was in the tens of thousands. So, like, unfortunately, by taking the convenience road of just making that check mark and signing off, it was too far gone for us to be able to help at that point. And so it's really important that you do that prior because, like you said, he's going to spend $25,000 more over the life of that there's over the term of new mortgage he took
Right.
when
Just on
you know
interest.
just on
That's not even
interest. Yeah,
when we broke it down, it was like 26,000 in new interest, but it also was like an extra couple $100 in the monthly payments. Like, it was such a substantial ding. Like, and all it
yeah,
was I just got offered by my bank.
yeah,
I got a letter from the bank that holds the mortgage, and I just thought, yeah, that's fine, and check it. I remember when
yep,
I told him, like, we were at this dinner, and I was like, they're giving out 4.5. His face fell like 8 stories. He was like, "What are you talking about?" I was like, "I'm
yeah,
telling you, we're doing deals right now where we're getting 4.25, maybe 4.5 for new mortgages on buyers." Well, I didn't know that. Well, no, because unfortunately, not that the bank is. I'm not going to say anything negative there, but it's also in a sense of they're preying on your ignorance or the ease of the transaction of, hey, like, your renewal is up, come sign this, you're ready to rock.
yeah, for sure. Like that is spot on. They're basically saying this out, and they're saying, sign here, and you get another mortgage. And I also think that another thing about that is I don't know how much people know that there's an option to shop around, that you don't have to take their offer, that you can take your mortgage to another institution. They're more than happy to have you and bring you on board. And guess what? When your renewal is up with that new institution, the same thing's going to happen. And so to have someone on your side and be a teammate of yours to help you each time with that is super important in terms of trying to save the most. And also you can do this yourself if you're listening and don't want to use a mortgage broker, even though they are a free resource for you. You can
A
go
little
shop.
plug.
You can go shop around. Well, that's what we do, right? That like we don't cost you a dime, and we have access to all lenders and can shop that around and show you what the best things on the market. But let's say you don't want to do that. You can go to each bank and say, what's your rate, and you can do that shopping yourself and save money. Um, and secondly, I don't think people also know it's an option that you can take that consumer debt, the credit cards, the lines of credit, the loans, the personal loans that you have, and you can work that into your mortgage, and you can pay a much lower rate on that and have a much lower payment and benefit from the equity that you've gained. And that is, I think, one of the big things is like this individual that we're talking about,
Oh
they
my
just didn't
god.
really know that that was an option. And so trying to make people aware that they have these options is a really big push this year for us because of how many renewals are coming up. That is definitely a big thing that we are going to really try and do this year is educate people and them understanding that that option is available to them. It's not as scary as you think. We're here to help you. We're on your side. We are not don't have the best interest of the bank. We have the best interest of you, the individual with the mortgage, and helping you. So
The the
that
other
is a big
thing
thing.
that I wanna make clear for you guys, I'm just gonna give you your own plug here, is the bank pays you for bringing them a new mortgage. The client doesn't even
Correct.
pay you, right? Like, you're a free advisor, you're giving them all the benefits of this, of your knowledge and expertise, you're doing all the work for them, and the bank pays you guys, not the client, right?
You got it.
So, it is a win-win, it's just having someone be able to be an advisor in your corner, be like, "Hey, like, my bank offered me 7," as an extreme example. Like, no,
Yep.
no, they're giving out 4 and a quarter. Like, that's,
And, yeah,
let's have a bit of
and one step
nuance.
further than that, like our pay that we get compensated doesn't come out of your rate. So like it's not like if we didn't take the pay, your rate would be lower. So like it's not built in that way. There's a, I'll say that with an asterisk. There are certain specialized programs that is somewhat the case, but 99% of the time, it's the referral fee that we're getting for bringing the business to them. It's set up long before we approach them with your specific file. So we're a free resource. We do what's our fiduciary duty has to be with you, has to be what's in the best interest of you, not what's in the interest of the bank, which is a 7% mortgage, not a 4, right? They will make more money. And we also see all the time where people will go in that are aware you can refinance, and they'll say, "I'd like to refinance and work in." A few years ago, had a really great client, great credit, great job. It's a pilot, and went into their bank, one of the big 5 banks that everyone is aware of. Went in and said, "Like to refinance and working it with $70,000 in consumer debt," and they said no. And
Wow.
yeah, and they said, "Oh, it's not working out." So he got introduced to me, ran it. His ratios were completely fine. The thing is that the bank is, they make good money on those other
Debts.
debts, and
Yeah.
when we sit here, we don't know the exact reason they said no, but when you look at it and the ratios are all fine, the credit's great. There's no reason you should be denied. There's only one
There's
thing
only
you can
one thing
point a
left,
finger at,
right?
and that is that they're making money off that other debt.
Because they would
And
have, if they had a refinance, they would have poured all that debt into the new mortgage. That would have dropped the interest rates on $70,000 from 13 if you're getting a line of credit, 22 if you're on a Visa, Mastercard debt. You know what I mean? Put
yep,
that, and then don't forget student loans. If you put that all into a mortgage, like realistically speaking, if you had 70K to a mortgage at 4%, like it's not that crazy on your monthly mortgage payment.
yeah, it can be a bit, yeah, exactly. It's a big difference when you're paying out the debt. There's a big payment difference there, but when you're adding it to a mortgage that's amortized over many years and the interest rate is much lower, there's a it's not adding that much to your current mortgage payment, a lot less than the payment you're making on the facility itself.
Right, 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 right. Um,
Yeah.
Here's a question for you. Getting out of the service to the individual, what's your take on the landscape this year? Like in terms of your seeing clients, is anyone going bust? You know what I mean? Because the whole theory is that the renewal cycle is going to give us so much supply because people can't afford their homes anymore. I'm looking at like the 700,000 to $1 million listings to be like where that's probably where you're going to eat the most because it's going to be such a higher increase in payment. But how are you seeing your clients? Are people being able to manage these increase in payments? Are they okay with the increase in interest rates? Like, how's it looking from your end?
Yeah, that's a great question. I don't, the sky is falling, narrative that is being sent out. Um, we personally, I'm not seeing that. I'm not seeing that with
Yeah.
my own clients. I'm not seeing that with people coming to me. Um, because if you're in that situation, right, where money's tight,
Call
um,
call Andrew, please, if you're in that
there's
situation.
there's
Call
ways
him.
around it, right? Like let's say you bought the house 5 years ago, so you have a standard amortization is 25 years, so you have 5 years knocked off that. Now you're at 20. Well, if that increase in payment has put you in a place that you're now kind of strapped for cash, that means you probably have other debts on the go. So let's take a look at those. Can we clean those up? And if so, that's still kind of maybe you lost your job, maybe something like that. Well, let's look at pushing your amortization out to 30 years, and then having that payment come down a bit. Because yeah, the sound of adding 10 years to the mortgage, it doesn't sound like great. I don't really want to add 10 years to my mortgage, and it doesn't have to be a permanent thing. Is that's the whole strategy here? Is that okay? Well, because right now you are maybe off work or you've added some debt into your life, let's work it into the mortgage. If that's still not the case, we can add the 5 years back to be a 25-year am, or add an extra 5 years for a 30 while you get back on your feet, get back to work, so that the payment's still manageable. And then once you're back working, bring it back down to the 20-year mark. So there's strategies we can do with that to make it more affordable. Um, so and you know adding 10 years to your mortgage is a better solution than selling your house for a loss, and
Yeah.
not paying your mortgage and going bankrupt or something like that. So I there's ways around it, of course. When you say you're going from a 1.9 to a 2.2 or 4.2, that sounds like a very drastic jump, and it is. It's big, but it's not enough to send you into a financial spiral downfall that's going
Right.
to make you default on your mortgage and lose your home. I think that is I think that narrative is something that is catchy and is easy for news outlets to pick up and run with. But in reality, when we approve you, we don't approve you on using 100% of your income to buy a home. There's room in the ratios to be able to absorb all of that, because when one of the best things, Canada OFSI, the Office of Superintendent of Financial Institutions,
Stress test.
one of the best things they did was introduce a stress test years
Right.
ago. And so all these people that get a 1.9 or 2%, 1.5% interest rates, we didn't approve them based on that interest rate. We had to approve them at 5.25%. So your ratios had to work as long as your rate went up all the way to 5.25. So technically, anyone in those mortgages should still be able to afford a 4.25.
The the only devil's advocate here is we talk about this earlier, people's spending habits. The devil's advocate and the theory and the thought is people get approved at 5.2% when they bought. They're getting a 1.9. So there's obviously a difference in available cash flow. They use the available cash flow in other areas now. Oh, I have some money here. New car, new trip here. Oh, I want to do some rentals. I'll slap down on a line of credit and then I'll pay the debt down. You know what I mean? Like that, the theory
Absolutely. People live to the means of what they're earning
able
or
to.
go above. The
Yeah.
thing the and that's a great argument, right? Like, I mean, everyone kind of lives that way. How much money do I have left over every month when things are done? Oh, let's go spend it on something. That's why you
We're
work.
going out
It's just,
tonight.
that's why you work, right? Is to go spend the money. And so what I'd say to that, though, is the last thing you're going to let go when you are in financial binds is
Your house.
two things: food and your house, right? You need to eat and you need to live somewhere, which means the nice car you bought, the line of credit that you put a bunch of shopping stuff on, that can go. And so that will go before your house goes. So you sell the BMW, or you get someone to take over the lease. And because there's two numbers we approve you on when we approve you. One is a GDS and TDS, so your gross debt servicing. That only takes into consideration your income and the cost of the home. So any
Right.
debts you add on top does not affect that ratio. So at 5.25, you should still be able to, at 0.25% interest, which is what we approve you on back 5 years ago, you should still be able to, your ratios shouldn't change for that number. Actually, probably your ratio should go down a bit, because in 5 years you're probably earning a little bit more money. Now TDS, which is your total debt servicing, which is the second ratio we have to approve you on, that's a bit higher than the GDS. It's about 6% higher, and 5% higher. And the reason for that is because there's going to be other debts you take on in your life. So that number, that ratio, the TDS, your
Can
total debt
change.
servicing, can change, and that is the one that you're talking about, where it has likely gone up. However, that one you can bring back down. You can bring back down by selling the thing that you bought, the boat, the car, insert toy, um, or any debt that you've accumulated, working that into your mortgage and having it done that way. So although that is a great argument and people did that, people will lower their standard of living
before giving
before
up their
they
house.
before defaulting on a mortgage,
Yeah,
right?
yeah.
So
Yeah, they're not like money's tight on the mortgage. How about we go party? Well, some people would, not everyone, but that's not the majority of people. I I know going into 2026, there is a lot of chatter and there's a lot of expectations of like the market may they've been screaming market correction for 20 years. Way more intensely now the last 5 given what the market's been doing the last 5 years in real estate. It's just a matter of trying to bring some logic and conversation and some nuance of like, okay, like if you're trying to time the real estate market, like it you can't time it, don't know how to. You can bring all the theory you want into interest rates are too low, when they renew, they're screwed. Well, okay, but that was the stress test. You can bring it in, like, what's the new mortgage payment going to be? So here's a question. You see people renewing now from a 1.9 to, let's say, a 4.2. What's the point? What's the payment jumping up to? If they don't port any other debt into this mortgage, let's say 1.9 interest rate, $500,000 purchase, going to a 4.2. Just so that to get the idea of like, okay, how substantial is this new mortgage payment for a new 5-year fixed, right? And they may even go into variable, which is lower than fixed 5-year fixed right now, because there's a lot of speculation that we're going to see more interest rate cuts in 2026. So like there's a lot of nuance here in this discussion. I'm just trying to get a ballpark of like what these numbers may look like in terms of what a renewal looks like. Cause like someone might be terrified of a renewal today and realize that it's only $400.
so here, let's just
Yeah,
do one
I
right.
get it.
Let's do it right quick though. We'll do a mortgage
Okay.
calculator. So if you're going to oh,
You know what? We'll go Halifax's rough average price. So 600K was Halifax's like rough. I don't know the number off the top of my head, but 600K was the average price in Halifax for November.
okay, and let's say you did a $50,000 down payment.
Let's say that.
Sure, put you a $550,000 mortgage.
Right.
Let's say you
Yep.
what do you want to do? 1.92%? What do you want to do?
1.92%. Let's go 1.9 to
Okay,
to what
1.9.
the rates were, right?
Yep. So let's say you're 25, you did a 25-year mortgage,
25-year
1.9,
AM.
25-year AM, yep, sorry, amortization, 1.9% is your interest rate, $550,000 mortgage, your payment is $2,302. So we got 2,302. And let's say
Let's say you paid down 30 grand in principal
sure.
over the last 5 years. So you're at 520.
And let's say we're at 4 right now, you get,
Four and a quarter.
let's just say 4.2. Yeah. Oops. 4.2. You're looking at 2,791 dollars, a difference of $489.
That's still a lot to eat.
It's a
That's
lot.
just
That's a big
because
jump.
that's an extra 6 grand.
That's a big jump. Yep. Absolutely.
So
Absolutely.
that is what we're talking about here, is to be like, okay, what do the actual numbers look like for these new renewals? Because it will put stress on people.
Well, and
Yeah.
we'll take it one step further too, right? And let's say you can get a 4.2 right now. But
Okay.
let's say your let me just bring it back to 4.2 so I have that number. 4.2 was $2,791, right? But let's say that your bank offers you a 4.7 because
Yep.
that's what they send you. So that is $2,936, a difference of
Right.
$145,
Right.
right?
Right.
So
Right. So we'll
um
take it a step further and show exactly what the bank offers you, because they might even offer you a 5
yeah,
because you're not paying
exactly.
attention to the interest rates.
Even just that difference right there is a total of $8,700 over a 5-year term.
Woo!
Right. So
Right.
and yeah, it could be more, there could be a more drastic difference, right? It could
Well, if you're talking about like that's 600K, right? That's the average. That was the average price point for November 2025 of this year. Okay, simple. If you're talking about then you think about the 700K, the 800K, the 900K, the million, the 1.1s, the 1.2s, like that's where you're probably going to see a real crunch in what a monthly payment increase looks like. no one's saying that eating a $400-$500 monthly payment increase is good. That tacking on extra six K in monthly expenses with already high food costs, already inflation established. Especially if you got consumer debt over that last 5 years that you want to pour into a mortgage, you know what I mean? Like, no one's saying this is good. All we're saying is $400-$500. Like, you can find that. No one's happy about it, but you
No,
can
of course
find
not.
that, right?
Yeah. And
That's
that
where.
difference, and if you can't, let's say you can't,
Okay,
uh,
give me the worst case.
well, then you push it out to a 30-year amortization. And now you're at
Okay,
20, just over 2,500, 25, 30. So let's say, and what was the original one? To
it was
550 at
550 with 6K with
1.9.
600K with 50% down at 1.9 interest rate. We paid it off 5 years, brought it down to 520K, renewed at
Yep.
4.2.
That was, where is it? 25, so 2302. So now your difference is $220, $228.
So you essentially
So
cut that in half by adding 5-year AM, an
yeah, so if it's
additional
you're
5 years.
you're in a situation where, $500 an increase is not something you can
Sustain.
sustain, then it's why don't you put it to a 30-year AM, and you can still make the payment to the with the 20-year amortization, with that 500 extra dollars. And but if there's months that maybe that you can't, then you do make your minimum payment,
Right.
and you'll still follow the trajectory of your 20-year mortgage, right? So,
I want to
not
be
sure I
clear.
did a great job explaining that.
We're not suggesting that. We're saying, like, this is worst case. You don't want to sell your house. Your kids are happy in the neighborhood. No one wants to add an extra 10 years to your amortization. No one wants to do that. It's just a matter of looking at, like, okay, here are some solutions if you're listening, and this is like the worst case scenario for you on the renewal,
Yeah,
right?
exactly.
Because that's the thing is, can't like the renewals are going to come. Even going up at $500 monthly payment, that is hard to swallow. 6K is hard to swallow. So at least you have options on the table to be able to help yourself if that's the case. You could you could see if you see that come up a lot, like an extra 6K in yearlies, and you could see people list their houses for that. Because you like some people may not be able to absorb that and just want to get out of the house. It also might push some fence sitters off. Like, oh, I'm happy in my house. I'm comfortable. The payment's great. Oh, the payment's not great anymore. The house is too big. I'll just cut my losses. You know what I mean? Like,
Yep,
that might also help the market as well. But in terms of like
could.
real shock value that like really sends people to the market, I don't think that's enough, especially with all the options you're talking about.
Yeah, I agree. But here's the rough truth that maybe has a bit of validity that has been in the news and stuff, is that, like, you're not gonna go back down to the 1.9, the 1.5, and the sub ones, even the sub twos. I don't foresee that happening in the near future. I wouldn't advise someone banking on that coming back. So
Right.
what you need to have an honest conversation with yourself or a broker or a financial advisor, your spouse, yourself, whoever it is that the new rate that you're renewing into is very much what it's going to look like in the long term. Meaning, it's not like you're going to have to do this for 2 or 3 years and then you get back down to your 1.9.
Right. Right.
Unfortunately,
Right. Right.
that payment you
This
were
is this
making
is a new normal.
is, yeah,
Right? This is, and also it's not even any normal.
I was gonna
This
say
is
not
normal.
new. Yeah,
1.9, 1.5, 2 and 2.25, like that was abnormal. That was never
yeah.
gonna last. That was a
It's not
time when
sustainable.
no, that was a like if you wanted that to last, your homes would be selling for 750,000 Halifax because
Yeah,
that was the trajectory of those interest rates, right?
that's right.
Because the payments were a lot. A payment of 750,000 at 1.9 is a lot more manageable than 750,000 at 4.2,
That's
right?
right.
So
Yep.
the monthly payments are more accessible. It's not a thing of being like, oh my god, my mortgage gone up by a lot. Like, this is crazy. I'm going to play the game for it to go back down. When we say they're speculating of rates to come down. We're talking like another maybe 0.25 basis cut, maybe never one or two of those in
Yeah.
2026. And no one's even people were predicting that. I'm not even hearing that chatter anymore.
Yeah, like, I mean, it may like, we could see rates get into the mid threes or even low threes, but you're right, there was chatter of that, and lately that chatter has gone away. We're not seeing it as much anymore. In fact, maybe we might be seeing a little bit of the opposite. Um, but there is so much uncertainty right now that it's very, very hard to predict where rates are gonna go. And even if you just look at the different head economists of each bank, even they are in very different places with
Yeah.
their predictions. So, but to you had a great point, which is I, historically, you don't see rates sitting in the 2%. You see them sitting in the fours, the threes, fives. It's not sustainable for them to just sit in the 2% range.
There's no way an interest rate on your mortgage should be lower than inflation. That's literally free money.
It's well, yeah, and if we're gonna go the economic route, right? It's when the economy's doing well, then they're gonna increase rates so that the economy doesn't run away, and the economy is doing poorly, then people don't buy things, they hoard their money, they don't have much money to spend, which means businesses don't do well. And so the government comes in and says, "Oh, let me make money cheap in order to take out so that people take the money
Yep.
and start spending it
Yep.
to keep businesses, keep the economy going." And it's this cycle that kind of goes back and forth. But when COVID hit, obviously an unprecedented worldwide pandemic created huge complications for economies, and they really needed to make money cheap to stimulate the economy again, which is why those rates got to where they were.
I will say one exciting thing about this renewal cycle ending, like in the next year and a half, is we can finally put the COVID real estate market to bed. This is the
Yeah, it will
last
be done. It'll be
this is
done.
like
Yeah,
the
that's right.
last cycle of like
I never thought of
this
that.
these real estate markets were impacted by COVID in 2020. And this is what we're seeing the impact and fallout of the last 5 years of what the banks did and how the market reacted. When we
Yeah,
are done this renewal cycle and it's over in mid 2026, we can finally say that was the last of COVID real estate.
that's
Interest
right.
rates are
Yeah,
back to normal. People have renewed
yeah.
proper interest rates.
It'll sit in history where it should stay.
It'll sit in history where we can, if we ever want to get scared again, just look under the curtain and watch a scary movie on COVID and beat me.
Yeah. And it reminded me of something you said at the beginning of the conversation, and which is like when you know, from the housing market standpoint, I mean, COVID really increased the value of property in Nova Scotia drastically, right? So,
I I will
what we're
push back.
seeing,
I really want to push back on that because I've been very consistent on this podcast. Halifax was underpriced anyway.
yeah, absolutely,
We weren't 600K. I've been clear on that too. But like we were selling at 320 back in 2020 or 29, whatever the hell it was when this whole thing kicked off. We were in the low threes. We should have been four. We should have been 425 based off the rest
you
of
could
the
buy a
country.
house in the high twos.
Right.
Yeah,
Like a
yeah, yeah,
full house
like a
in a good
full,
area. Yeah.
absolutely, yep,
Yeah. We
yep.
bought I had a client buy a brand new build in September 2019 for 274 what's that subdivision in Spryfield? The nice one.
The I don't,
It
oh
starts with a
man,
B.
oh,
Anyway,
you're
you know
talking
what one I'm talking
Brunello?
about. No, that's Timberlake.
No, it doesn't start with a B. It starts
Governor's Brook. Starts with a
oh
G.
yeah,
Governor's Brook.
yeah, it does.
Governor's
Damn.
Brook. Right. So Governor's Brook 2019 fully detached 274.9.
Yeah,
That was 2019. You could do that. That is genuinely undervalued. So the idea that like real estate, yes, the jump seemed really quick. It was always going to go up. Like we were always going to have a boom of some sorts because the rest of the country is going through a boom. We were always going to have one. It just went really quick for real estate, and that's why I felt like such a sudden shock is because it went really fast for us. It was like overnight, you're like 400K. The next year
yeah,
it was 450.
and I think it went fast for, and I
It did.
completely jump on board with with exactly that statement, right? I think it went up fast for the rest of the country as well. It's just that they were already overvalued or valued at a much higher and more accurate um, spot. Whereas when it came down and it corrected a little bit, it was a lot harder for them versus places like Nova Scotia where all that we
Exactly.
didn't really go down because we were just coming up to a level of the rest of the country. And so we didn't see as drastic of a pullback, if any, to be honest. Um, so yeah, we're fortunate in this market that your equity that you gained is still sitting there. That's not the case for everywhere in the country. But here in Nova Scotia, it absolutely is the case. If you bought a house in 2019, 2020, 2021, 2022, you are sitting on equity that is still there.
Well, yeah, that's the thing. That's the saving grace for anyone that's trying to renew and put up a bunch of consumer debt. You can amalgamate that into your mortgage with the renewal. You can on a much cheaper interest rate, and you can survive by pushing it. There's so many options for you because the equity has gone up so much in this province, in this city of Halifax, that like the renewal cycle. I think there will be some turbulence. I'm not sure what price points will see that turbulence, and you may see new listings come up. The interesting thing will be the inventory. If we double, like we're not going to double. I don't think we're going to double our inventory again. We almost doubled it this
Yeah.
year. If we get another 700, 800 homes for sale that aren't moving because interest rates are still high, you might see prices finally come down because there's inventory that's sitting on the market.
Yeah.
Before we get out of here, because I gotta leave because I got an appointment. Last thing for people renewing in 2026. Give me your hot tips.
For my biggest tip is talk to a mortgage broker. If you reach out, happy to give free consultations to anyone that has a mortgage coming up. At the very least, I'll tell you you have a great deal. Don't worry about it. You're not going to better interest rate on the market. That's number one. Make sure you get a second set of eyes on your renewal. Do it in enough time. Don't do it 2 weeks or even a week before. It's too late. Do it. Ideally, you're 3 to 2 months out as when you want to reach out and get ahead of it. If you're not sure when your renewal date is, you kind of know the month, but you're not, reach out. We can help get that information, help you gather it, and just give you the peace of mind at least that you're getting a good rate. And if not, we'll show you what's available on the market. And then the second to that, and maybe the more important thing is if you are feeling financial stress and you own a home and your renewal's coming up, know that there's options possible for you to give yourself more breathing room month to month and work that debt into your mortgage and release some of that stress. And if that at all sounds interesting to you, reach out and get a free consultation and it's no cost to you and it can only benefit.
All right, sir. Appreciate you. Thank you.
As always, thanks my friend, and we'll talk
All right,
soon.
buddy. All right, buddy.
Bye.
Bye.